The Bailout Blueprint, How Failure Became Profitable. One. The pattern everyone pretends not to see. For 117 years, the same financial script has played on repeat. Banks take wild risks chasing huge profits. The bets blow up. The system teeters. The government rushes in with taxpayer money to save the system. And who walks away richer? The same people who caused the collapse. So what does that actually mean? It means banking isn't about capitalism anymore, it's about capture. When they win, they keep it. When they lose, we pay. Footnote. The cyclical bailout pattern reflects structural corruption rather than coincidence, demonstrating how modern finance privatizes gains while socializing losses. 2. 1907, the panic that made a king. The first modern bailout began with copper speculation gone wrong. Panic hit, deposits vanished, and banks stood ready to collapse. There was no Federal Reserve, only one man with enough power to stop the bleeding, J.P. Morgan. He locked the bankers of New York in his library and refused to let them out until they funded a rescue. He was hailed as a hero. But here's the twist, he saved himself first. Morgan used the crisis to buy competitors for pennies, expanding his empire with government blessing. So what does that actually mean? The first bailout wasn't a rescue, it was a merger by coercion. Footnote. Morgan's 1907 intervention consolidated private banking power under the guise of public salvation, creating the template for future crises. 3. 1929, the Great Depression's convenient survivors. 2 decades later, history rhymed. The Roaring Twenties turned markets into casinos. Banks gambled with depositor money, creating bubbles built on leverage and lies. When it all imploded, 9,000 banks vanished. But not the big ones. President Hoover's Reconstruction Finance Corporation loaned public money to Wall Street. Roosevelt later expanded it. J.P. Morgan, Chase, and National City, now Citibank, all survived, and grew stronger. So what does that actually mean? The small-town banks died, the giants got fatter. Moral hazard wasn't born here, it was legalized. Footnote. The 1929 crash entrenched government-backed financial consolidation, shielding major institutions while eliminating regional competition. 4. 2008, the bailout heard around the world. Subprime mortgages, ninja loans, and synthetic CDOs. Wall Street packaged fraud as innovation. When the housing bubble burst, the global economy went with it. Lehman Brothers collapsed. AIG imploded. The government's answer, TARP, funneled $700 billion to the very architects of disaster. Executives kept their jobs, their bonuses, and their arrogance. Not one went to prison. Meanwhile, millions lost homes and savings. The foxes were running the treasury. So what does that actually mean? It means failure became a business model. Too big to fail wasn't a warning, it was a strategy. Footnote. The 2008 bailout institutionalized systemic immunity, guaranteeing elite impunity through government capture of financial oversight. 5. 2023, Silicon Valley's soft landing. Silicon Valley Bank collapsed because it bought long-term bonds when rates were near zero. When rates spiked, those bonds tanked. Depositors panicked. The government stepped in again, guaranteeing all deposits, even those well above FDIC limits. Big tech and venture capital got rescued. Then, as always, the sharks fed. J.P. Morgan bought First Republic's assets at bargain prices, sweetened with taxpayer guarantees. So what does that actually mean? It means bailouts aren't about saving the economy, they're about keeping the club exclusive. Footnote. The 2023 interventions reaffirm systemic moral hazard, transferring private mismanagement risk directly to public balance sheets. 6. The perpetual cycle. Here's how it goes, every time. Banks gamble. The bets blow up. The government rescues them. Executives keep bonuses. Taxpayers eat the loss. 4 crises in a century: 1907, 1929, 2008, 2023, and not a single major banker jailed. The cycle doesn't just repeat, it compounds. Each bailout breeds a bigger one. Because when failure is rewarded, recklessness becomes policy. So what does that actually mean? It means capitalism's safety net only works for those who own the net. Footnote. Recurrent bailouts entrench systemic inequality, converting financial crises into wealth transfer events favoring entrenched elites. 7. The rigged game and the moral hazard. The revolving door spins. Bankers become regulators, regulators become bankers. Henry Paulson went from Goldman Sachs to Treasury and back to private finance. Timothy Geithner did the same. Policy isn't written by Congress, it's ghostwritten by the balance sheets of Wall Street. Meanwhile, the public foots the bill, through inflation, unemployment, and eroded trust. What's called a bailout is, in truth, socialism for the rich and capitalism for everyone else. So what does that actually mean? It means the next crash isn't a question of if, but when. And when it comes, they already know how to win again. Footnote. The entanglement of political and financial elites sustains a closed economic system immune to democratic accountability.